Good morning and welcome to this Wednesday, February 8th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. We got the market trying to rebound again yesterday. Middle of the day, we had Fed Chair Powell talking at an economic luncheon in Washington, D.C. And actually, I watched some of it, and it was he seemed very personable, much more so than usual. Maybe it was the interviewer, but seemed pretty down to earth and had mostly good things to say. If you're a bull in the stock market, if you're a bear, he's still clinging to some. The possibility of higher rates, going to continue to watch the data, may have to continue raising, that sort of thing. But many times did acknowledge the disinflation that has begun to take place. And I think that's a word that a lot of bulls have been looking for the Fed to acknowledge that this period of disinflation has begun. And so middle of the day, right around 12:30, 12:40, we saw the stock market take a pretty big jump to the upside after couple of days of pretty boring trading, just kind of drifting slowly lower. But we did have a big push up, and then literally like 15, 20 minutes later, we were right back down to new session lows. And then into the close, we saw a pretty big rally again. All of this taking place, though, within the confines of a period of consolidation. We didn't take out the recent highs I'm talking about from the last couple of weeks. We didn't take out or even get close to the 20-day moving average to the downside. So I think the consolidation period is continuing to run. But we're going to get into some of those charts in just a minute. Let me first take you over to Earnings Beats. For those of you who are new to earningsbeats.com, welcome. We certainly appreciate you tuning in. If you go to earningsbeats.com, if you really want to learn a little bit more about us and how we approach the stock market, I would suggest going to our website, earningsbeats.com, scrolling down. We have a free Earnings Beats Digest newsletter. All it takes is name, email address, no credit card required. You can unsubscribe at any time. We'd love to have you. 3 times a week newsletter, Monday, Wednesday, Friday. Very, very quick read, couple paragraphs and a chart, but it'll give you some insights into what we look at in the stock market. So, for instance, earnings, just from our name, you can probably tell, earnings are really important to us. We like to find companies that are beating estimates, top and bottom line. So we focus a lot on earnings, but we also look at relative strength. We look at price volume. We look at everything that most technicians look at, moving averages, trend lines, and so forth. Candlesticks are big in terms of short-term trading, in my view, to catch reversals, tops and bottoms, that sort of thing. But I think you'll learn a lot about us and about our style if you go to earningsbeats.com, scroll down, and make sure you get subscribed there. This morning, before we get going, I will tell you the futures are lower. We've got Dow futures, at least as of about 10 minutes ago, Dow futures down about 120 points. S&P 500 futures down about 20. NASDAQ futures down 58. Crude oil prices up another buck today, a little over 1.2%, back above $78 a barrel. Energy got a big boost yesterday. We're going to take a look at energy here in just a few minutes. The U.S. 10-year Treasury yield down a basis point, 3.66%. And at least looking across the board, a little bit of relative weakness in the NASDAQ this morning. We've seen relative strength so far in 2023 in not only the NASDAQ, but in most areas of growth. Anything that's aggressive, risk on, those types of assets have performed pretty well so far in 2023. And that's one thing I will keep an eye on as we move forward. Let's take a look now at what happened yesterday. So the Dow Jones Industrial Average yesterday tacked on 266 points. S&P 500 up 53, NASDAQ up 226. Mid caps 19.5, small caps up 9 on a percentage basis. Again, NASDAQ leadership shined through, gaining almost 2%. The AD lines, which I've talked about a lot throughout 2022 and into early part of 2023, they stayed relatively strong in 2022. I talked a lot about manipulation in the market. I thought the first 5.5 months of 2022 was distribution, pure distribution, selling, open all day long, selling. We got to May, and when we put in that June low that took out the May low, things had changed. All of a sudden, we were still getting those gap downs at the open. We were still getting the selling in the morning, which I call amateur hour. But by the rest of the day into the afternoon, we were seeing buying. There was accumulation taking place after June. Now, you could look at the chart and you wouldn't see it. Obviously, we had a nice bounce from June into August, but we ended up going back down and putting in another low in September. But that lower low came with a lot of accumulation that was taking place under the surface of the market. I wrote about it. I talked about it. I said Wall Street is gladly taking shares that anyone wants to sell. And then at the end of it, we would see the results, a move back to the upside. And that's what I believe we're in now. I think we bottomed. Again, if you're new, one thing I've pointed out recently, probably worth mentioning again, if October ends up being the low, it will be the 7th time in the last 14 bear markets that we found a bottom in October, in the month of October, which is why that low in October seems rather important at this point. The stock market has a history. I mean, there are 12 different months. Pick one. Why does October always have to be the low? October 2022 would be the 7th bear market out of the last 14 to end in the month of October. So I think the timing was good. I think all the signals were already lining up for a bottom. Those who thought we were just going to crash to zero, that's not the way the stock market works. Yes, we do have secular bear markets from time to time where we see 50% drops, but get your hand ready. There have been 3 of those since 1950. 3. Everybody always wants to call for a really bad market, a depression. It rarely happens. Rarely. And we've had 2 in the last 2 decades. They don't happen that often. Cyclical bear market is what you should think most of the time. The market will let us know by its duration to the downside and by the depth whether or not it's secular or not. When you start seeing signals that the market is bottoming, you need to pay attention to them because most bear markets are cyclical. 11 out of the last 14 have been cyclical, and there have only been 14 bear markets since 1950. 11 short-term, 14 long-term. And when I say bear market, I'm using the 20% threshold. There have been 14 periods where we've dropped 20% or more. And I like to only count the 20% drops from all-time highs. So you might have bear markets within a bear market where you're going down, you bounce, then you have another 20% drop. I don't count that second one. You're still in the longer-term bear market. Anyhow, looking at the sectors, you can see energy had a big day yesterday, up 3.25%, technology 2.5%, communication services 1.9%. Really important to notice technology and communication services, especially that latter one, communication services. It was a horrible 2022. Notice the bottoming head and shoulder pattern, though. Left shoulder, neckline, head, neckline, right shoulder, and boom, back to the upside. Communication services has put in their bottom. It's confirmed. We've broken out. This is a group I really like in 2023. I think internets, which were so weak in 2022, are likely to play catch up throughout 2023. This is a group that I'd be very interested in, especially during pullbacks. Not performing so well yesterday, staples and real estate, 2 defensive areas. So the market did well, and this is kind of what happens in bull markets. Money is focused more toward the aggressive groups, not so much toward the defensive groups. All right, 10-year Treasury yield. Let's get the latest there. So right now, 3.658%. I think we're sideways consolidating. I think the long-term picture, higher high, higher low, higher high, higher low so far. The uptrend's still intact. Long-term, I don't think it goes higher, but right now, the long-term trend, and when I say long-term, I'm just going back the last year or two. If we wanted to go really long-term, like the last 50 years, I would argue that we're still in a downtrend. But looking at this chart, longer term, based on a year, uptrend. Short term, and short term right now, I'm just talking about this little move right here. Short term, we're trending higher. Intermediate term is where I'm saying maybe it's sideways consolidation. So off of this high, we come down, we put in a low. There's that reaction high. There's the equal low, roughly equal. Same thing again earlier this month, roughly equal again, right around 3.37%. And then we go back up. I think in the short term, we'll break this trendless environment if we go through 390 to the upside or 337 to the downside. In the meantime, I think we're just sideways consolidating. As far as economic news goes today, this has been a really light week. Nothing came out on Monday. Really nothing yesterday. The only thing that we had was that speech from Fed Chief Powell. Today, I mean, you get your wholesale inventories of that comes out at 10 o'clock. Let me see what the wholesale inventories number. Consensus is a rise of 0.1%, which would be good because in November, would be the December number, by the way. For November, we rose 1%. And one of my biggest fears, I know a lot of folks talking about inflation. I have said my biggest fear is deflation. Not that I think we're heading for deflation, but if the Fed makes any major missteps, market will tell us. Trust me, the market will tell us. But if we start to if the market begins to think deflation, that would be the bigger concern for me. Much, much bigger than much bigger than inflation or a recession. Recession's temporary. Inflation seems to be getting under control. There are many ways to get, well, not many ways, but raising rates is obviously one way to get inflation under control. That's what the Fed has done rather aggressively for the past 8 months or so. So we'll see what happens from here. I mean, I don't have a crystal ball, but I do believe that I've been seeing signs that inflation is rolling over. I've been talking about it for the last 2 or 3 months. The Fed now is beginning to talk about it. They wanted to see a series of reports suggesting that inflation was starting to roll over, and I think they've seen that now. And so they're starting to feel more comfortable talking about disinflation. And I hope they're right. I hope it's disinflation. I hope it's not deflation. I don't believe it is. Don't, misconstrue what I'm saying. I don't think we are headed for deflation. But that would be my biggest risk, is if the economy were to start slowing and the Fed keeps raising rates, you could trigger a series of lower prices. And I've had a member write in and say, well, isn't that good? People were waiting for prices to come down to buy things. Wouldn't that be a good thing? Well, the problem is it's a psychological thing. And when you start seeing prices drop, the last thing you want to do is buy because you think they're going to drop some more. So what it does is it lowers demand again. And so as demand lowers further, prices drop again, trying to get rid of inventory. You keep this spiral going and it's never ending. It can be if you really start to get into a period of deflation. And the problem is the Fed is limited. I mean, yeah, Japan went into negative interest rates. I guess you can go negative interest rates, but in theory, you go down to zero interest rates. Then what do? Do you go negative? I just think the Fed gets a little bit handcuffed. And if you look back at history and you look at what happened to us back in the 1920s, 1930s, and you look at what happened to Japan in the 1990s and into the 2000s, you will see a stock market that continues to spiral lower and lower and lower and lower and lower. You think the 25 or 28% that we had in 2022 is bad? That's just like a scratch. That's the surface of the wound. So you don't want deflation. Anyhow, I don't think we're headed for that, but it's worth monitoring, thinking about. And anytime I get an inventory report out, I just want to check it because I don't want to see massive builds in inventories. All right, S&P 500. So what's going on? Well, we made the breakout, talked about really needing to get through this double top here and that reaction high there, 4,100 to 4,110. We did it. We pulled back. We actually went right back down to 4,100 and then bounced off of it. Are we going to go back to new highs? Possibly. Don't know. I will say that the selling, you don't see any real big red filled candles. It's not like there was a lot of selling intraday. What we've been seeing is what we saw a lot of in the second half of 2022, where we saw gap downs followed by recoveries in many instances. So there was, a lot of the down moves that we saw were either at the open or in early morning trading, and then we saw buying rest of the day. Here, and I'm watching 2023 to try and get a sense of, because once you start turning, you start moving higher, you don't trade the same way. We shouldn't be sitting back waiting for big gap downs. In a bull market, you rarely get big gap downs. So one strategy that I had personally in trading in 2022 was if I was going to buy anything, I was waiting until around 10, 10:30, 11 o'clock in the morning. Just let the opening gap and the morning amateurs sell off and set up some great opportunities for the second half of the day. I don't think that we're in that kind of market anymore. I think we've got to be really careful. And that's why I said I'm analyzing the market, because I think what's going to happen is we're going to start seeing more gap ups and more buying in the morning. And then we'd see sell-offs during the day, and then perhaps some buying late in the afternoon. That's more what a bull market looks like. And we saw that a little bit yesterday. We had the gap down. We were down early. And then we took off, of course, the Fed, that speech. That was an anomaly, I guess. We're not going to get that every day. But afternoon buying, last hour or two, we had a really strong move. And if you weren't paying attention, this is what yesterday looked like. So again, we were just kind of meandering. There was the high, there was the big move. This was the pullback. And by the way, that right there was the Fed announcement last week. And so we rose into that. And then, of course, the big jobs report on Friday was very, very hot. Gap down. We did recover, filled the gap, and then rolled back over in the afternoon. And you could see just a little bit of pullback, a little profit taking off that big run we had. And then during the speech, right around 12:40, boom, market takes back off again, comes back down, puts in a new low, and then look at the rally into the close. Actually took out that intraday high, that spike that we had around lunchtime. So it was a really good day for the S&P. Hard to, really say anything else other than that. It was a nice day after some selling recently. We came back. I think 4,300, if we go back to that daily chart, I think that's the really key level now to the upside. And that is, if you're looking at the market, a little bit longer term, let's go back 18 months. I think it's pretty easy to see the lower low, lower high, lower low, lower. Well, actually, I would go all the way down to this move. Lower low, lower high, lower low, October low, possible bear market bottom. And now we're rallying back up off of it. And I think if you take out that 4,300, I don't really know what bears are clinging to at that point. If you're bearish, I don't know what you're clinging to, because technically everything's turned around. I think throughout the second half of 2022, my signals were telling me we were bottoming as it was. I called a bottom right there, middle of June. And then at the end of September, I said, you're getting a second chance. We went down. When I looked there, we had closed 5 days. 5 days we closed below that June low. And so for the most part, market's been back up off of those lows. And that's what, in my opinion, that's what the market's been suggesting it was going to do. I think we go through the 4,300. I don't know if we go through it immediately. And if we do rally later this week and we move to new recent highs, one thing we're going to have to be very careful about next week, options expiration. It's a great time to be an Earnings Beats member when you approach options expiration, because we're going to tell you literally dozens and dozens and dozens of stocks that either look good going into option expiration or stocks that you want to avoid going into options expiration. And if you have not been a part of options expiration before and don't understand how it works, well, just use October as a guide. See how we were going down, setting new lows? There were a ton of in-the-money puts. The in-the-money put premium was in the billions and billions of dollars. Look at the rally into the third Friday in October. So Got to keep that in mind. And you go all the way back to March. Remember March? Look at this move down. January and February, we went into option expiration week with billions and billions of money of net in the money put premium. How do you wipe that out? How do market makers make a lot of money? By buying stock and wiping out those puts. Right at the last minute, you can see afterwards, we end up going lower. So it's not a long-term call. It's strictly a short-term call. But when we're sitting at multi-month highs, well, then you got a lot of net in the money calls. And we're going to be talking about that over the weekend when Aaron sends out our Max Payne list showing all the Dow stocks, all the NASDAQ stocks, all of our portfolio stocks, where they're trading and where their Max Payne is for the following Friday. And that's a very, very important piece of information to have as a trader. Listen, if you're long-term, pay no attention. Doesn't matter because it doesn't always work. And of course, if you're long-term, you decide, hey, I'm going to get out this time. Let's wait for this pullback. And the market keeps going up. Well, you can have some problems on your hands there. Anyhow, let's move on to the NASDAQ. So the NASDAQ 100, same thing. There was your highs that we needed to take out from November and December. The only main difference was that the NASDAQ was underperforming back in the fourth quarter. You can see it almost back down to the October low in late December. When you look at the S&P 500, look at October versus late December. Much different picture. The S&P was well off its lows. A lot of value stocks were being bought in the fourth quarter, which is, by the way, typical for the fourth quarter. I wouldn't say that had anything to do with this bear market. If you look at history, value stocks tend to perform best in the fourth quarter, especially November and December. And then growth normally returns in January. January is the best month of the year since 1971 for the NASDAQ. And so while the S&P has been going up, the NASDAQ has just absolutely exploded to the upside. And look at almost all of these candles. Almost all of them are hollow. If you're not a candlestick fan, the bottom of the candlestick or this rectangular portion, I'm going to, let's just do like a 3-month chart so you can really get a good idea of what these candlesticks look like. So this candle, what it's telling you is that when you have a hollow candle, the close is above the open. So just think bullishly, a hollow candle with, thinking nothing else, you're closing above the opening price. That's going to generally be bullish, right? Because you're going up during the day. This little, what they call tail or shadow or wick coming out of the bottom here of this candlestick, that low of the day is marked by that wick. The high of the day is marked by the wick on the top. And then the candlestick itself is just based on where you close versus where you open. So if you have a hollow candle, anytime you have a hollow candle, you're closing above the open. Now look back since January 5th. I count one day right there where there's, pretty good selling and a second day right there. I think that was after wasn't the Microsoft report. Actually, I think the Microsoft report was probably one of these big gap downs in recovery. So here you can see, well, this is a red outlined hollow candle. This is a black outlined hollow candle. What's the difference? Well, the red outlined hollow candle means you still closed below yesterday's low. So yes, you gapped down, you closed higher than you opened, but if you didn't see anything except today's close versus yesterday's, it was still down. When you have the black outlined hollow candle, it means you closed not only above the open, but also above yesterday's close. So you made money. If you were just in the NASDAQ 100, if you were in the QQQ, you made money. With this red outline, if you held it from one close to the next, you actually lost money, but you were down a lot more at the open and you came rallying back. So that's the difference. And on the filled candles, it's just the opposite. So red filled means you're closing below the open and you're also closing below the prior day's close. A black filled candle means you're closing below the open, but you're closing above the prior day's close. And that's real. Once you get used to candlesticks, I can look at a chart and just visually, things just pop out at me on the charts. I love candlesticks. Anyhow, for those of you that maybe weren't familiar with candlesticks, maybe that'll help you a little bit in the future. Let's take a look at energy, because energy had a big day yesterday, and I wrote about this yesterday to our members at Earnings Beats. I do a daily market report every day. I think one of the pillars of our service at Earnings Beats is guidance, market guidance. I don't know that there was anybody who did a better job of guiding the market, or guiding members, or guiding traders, investors in 2022 than Earnings Beats. We were bearish to open the year. We turned bullish in June. And if you followed that, if you got out at the beginning of the year and got back in June, you're up a lot, especially if you shorted during the first 5.5 months. But anyhow, in the daily market report yesterday, what I pointed out a continuation pattern here, at least the potential for one. And the thing you have to have first is a trend. You can't have a continuation pattern if there's nothing to continue. So in this case, the XLE had a beautiful trend up, broke out the new highs. That clearly is an uptrend. I hope everybody can see that. That's an uptrend. But what it's been doing lately is it's been consolidating. We have equal highs right there. So equal highs. Now, what sometimes you do is you go into a flag pattern. You can go back down, have a low, high, another low comes down, test it. And so you go up, you just consolidate for a while and then break out. Rectangular consolidation, flag, whatever you want to call it. In this case, what I saw yesterday with that reversal is the potential for an ascending triangle pattern, which is a bullish continuation pattern. So, you know, and you could say, well, this is a cup. Well, it's kind of a cup, but that handle came down way too far for a cup. Normally, the handle should not come down more than 50% of the measurement of the cup from top to bottom. So here we came down more than the 50%, but right now this looks like a trend line. And so this is point A, point B, point C, potentially point D. And if we go back up and break out, that's point E. That's your breakout of an ascending, or excuse me, of an ascending triangle off of an uptrend. That would measure from roughly, let's just call it 93 down to 82. So $11, it's actually more like 93.5. It's going to measure up to about 104 or 105 on a breakout. And that's why I like patterns. I like patterns because they give you measurements. I mean, anything that's bullish, when you get a breakout, any breakout I'm bullish about. But when I see a pattern, it helps me identify a potential target. So again, a breakout above 93, 94 here, I think would lead us to about 104, 105 on the XLE. All right, we got just a couple of minutes left before the market opens. Tell you what we'll do is, let me just see what we're doing here. So we can pull up, if you use symbol summary at stock charts and hit the ETFs that track the major indices, you'll see that the Dow right now, the diamonds are down just about 0.25%. Spiders down about 0.5%, and the Qs down just about the same, about 0.5%. So we're going to get off to a little bit of weakness here this morning. We'll see what happens later in the day, but it does look like we're going to start a little weak. I want to just walk you through on the technology area, the 8 industry groups on a relative basis to the S&P 500. So computer services index bottomed relative to the S&P 500 back in February, March, April of 2022 and started strengthening. We've rolled over a little bit. I think as long as we still hold on to this low right here, we're still okay, although this is not one of the best areas of technology at this point. Semiconductors flying right now. Remember, they were a big drag on the market in 2022, all the way into that October low. Well, they're not a drag anymore. This is leadership right here. This is what leadership looks like. We are moving straight up. And you can see that relative PPO has gone positive again. So we've got relative momentum building to the upside in semiconductors. So if we go through a period of weakness, this is a group I think as a trader you should be looking at. Software, finally getting going. Is it going to get through the 50? Are we going to get that move on the relative PPO through the center line? I don't know. But this is an area that is strengthening. You need to be aware of that. You got electronic equipment already strengthened. What I really like to see is this configuration where relative price action is above the relative 20-week moving average, which is above the relative 50-week, and they're all trending higher. The 50 is now starting to turn. So this is a nice looking group right now. Computer hardware has strengthened. Of course, Apple has caught fire recently, but it's not quite made the move just yet, but it's getting there. Then we've got electrical components and equipment. This has been a strong group since April of last year. It's very strong relative performance there. And configuration looks very, very good here. Telecom equipment, not so much. It's rolled back over. It's been more flat. Really, the last couple of years, you get a little strength, little weakness, little strength, little weakness. Not really anything you can count on there. Last thing, renewable energy. Renewable energy is back on. Enphase Energy reported after the bell last night. They were up 20 after hours after a pretty rough period recently. But let's see. This will be the last thing I show you. Enphase just opened. So it's up $12 right now. So pretty strong gap up. It has sold off here in the first minute or two of the market. Let's see what the market's doing, and then we'll wrap up and let you go. We got the Dow Jones down 127, S&P down 20, NASDAQ down 54. So right about what we talked about just a couple minutes ago in pre-market. That's about where we are right now. The VIX remains low. I will tell you this. The VIX, one of the things I'm watching for, when we were going down at the end of the fourth quarter, even when the S&P rolled over, the VIX rolled over and went lower with it, which is very unusual. The market was going down and fear was coming out of the market. That is usually a reversal sign. In my experience, I wrote about it. I talked about it back at the beginning of January, that the VIX was saying that we were likely to explode higher, and that's what we did. Well, the VIX is still staying down. I mean, it's up fractionally, but the market's down. I mean, we're still back on. We've been hovering below 20 now for the most part for a little while. Unusual compared to anything we saw in 2022. And what I can tell you about bear markets is that once the VIX goes below 16, really below 17, but especially below 16, the bear market is over. We don't go back down to new lows. That's been the history. So watch the VIX at 16, 17 area. I think that could be a really good area to, if you're not already in, you should be in my opinion. Of course, I'm not a registered investment advisor. You got to do your thing. But in my opinion, really dating back to the middle part of 2022, it was not worth the risk to remain short. When I make bottom calls, it's not because I can guarantee a bottom or I have a crystal ball. It's because I'm starting to get signals that say the risk has shifted. That's the important difference between, some people say, well, it's pointless to try and pick tops and bottoms. Well, maybe so. Maybe I got lucky, but it's not pointless to manage your risk. And you get a lot of signals that can help you do that. Anyhow, we can see just another quick turn down on the NASDAQ there. Well, I'm going to go ahead and wrap up. I appreciate everybody tuning in today. Again, if you're new, come on, listen to us Monday and Wednesday here at Earnings Beats. Also over at Stock Charts on Tuesdays and Thursdays. Go to Stock Charts TV at 9 a.m. and you'll be able to hear my show there 4 times a week from 9 to 9:30 Eastern. Have a great day, everybody. Happy trading.